The shift did not begin with a crash, it began with hesitation. In the early months of 2026, nothing appeared broken on the surface. Listings were still going live, agents were still hosting open houses, sellers were still anchoring their expectations to numbers that had worked in previous years, but beneath that routine, something fundamental had changed. Buyers were no longer responding the way they used to. For most of the past decade, the housing market had been defined by urgency. Buyers moved quickly because they had to. Offers were written within hours. Bidding wars escalated beyond logic. The fear of missing out was not abstract. It was measurable in dollars lost by waiting even a week. That environment trained buyers to act without hesitation and, more importantly, without negotiation. The training is now being undone. By 2026, the first signs were subtle. Homes stayed on the market a few days longer than expected, then a week, then two. At first, sellers interpreted this as temporary friction, seasonality, interest rate noise, or local variability. But the pattern repeated across multiple cities, across different price ranges, and across different types of properties. The issue was not supply alone, it was behavior. Buyers had stopped chasing. This change did not happen suddenly. It was built slowly through a series of pressures that reshaped how buyers thought about value. Rising interest rates over previous years had already stretched affordability to its limits. Monthly payments, not home prices, became the defining constraint. A house that looked acceptable on paper became questionable when translated into a long-term financial burden. For the first time in years, buyers began to calculate instead of react. That calculation introduced something the market had not seen in a long time: resistance. Sellers, however, were still operating on memory. Many had watched neighbors sell at peak prices. Others had refinanced during low-rate periods and felt no urgency to move unless they could achieve a premium. The gap between what sellers expected and what buyers were willing to offer began to widen. At first, that gap was small enough to ignore: a few $1,000s, then $10,000, then more. Eventually, it became the central story. Negotiation, which had effectively disappeared during the peak years, returned, but not in its previous form. This was not a balanced exchange. It was a recalibration of power. Buyers were no longer negotiating to win. They were negotiating to avoid overpaying. This difference matters. In earlier cycles, negotiation often revolved around minor concessions, closing dates, inspection repairs, or symbolic price adjustments. The underlying assumption was that the seller's price was valid. In 2026, that assumption no longer holds. Buyers are questioning the price itself. They are comparing listings more carefully. They are tracking price reductions. They are watching how long properties sit without offers. Information that was once secondary has become central to decision-making. Time on market, in particular, has become a signal of weakness rather than neutrality. A home that lingers is no longer overlooked. It is analyzed. And with that analysis comes leverage. In several cities, this shift has already produced visible outcomes. Sellers who list aggressively are receiving little to no response. Properties that would have triggered immediate competition just a few years ago now require multiple price cuts before attracting attention. Even then, offers often come in below the revised asking price. This is not a collapse, it is a negotiation reset. What makes this moment different from previous slowdowns is the mindset of the buyer. In earlier downturns, fear dominated. Buyers hesitated because they were uncertain about the future. In 2026, the hesitation is more controlled. It is not driven by panic, but by discipline. Buyers are willing to wait. Waiting changes everything. When buyers feel no urgency, sellers lose their primary advantage. The ability to create competition, real or perceived, becomes weaker. Open houses that once generated multiple offers now produce casual interest at best. Conversations that once ended with escalation now end with silence. Silence is the new signal. Agents are beginning to adjust their strategies in response. Pricing recommendations are becoming more conservative. Listing presentations include longer timelines. The language used to describe market conditions has shifted from competitive to selective. But these adjustments are uneven. Some sellers adapt quickly. They recognize the shift and price accordingly. These properties tend to move, though often at levels that would have seemed disappointing in previous years. Other sellers resist. They hold on to past benchmarks and interpret the lack of offers as a temporary anomaly. For those sellers, the market becomes a process of gradual realization. Price reductions follow a predictable pattern. The first cut is cautious. The second is more noticeable. By the third, the listing begins to attract attention, but not necessarily at the level the seller originally intended. Each reduction is not just a financial adjustment, but a psychological one. The longer the property remains unsold, the more negotiating power shifts toward the buyer. This dynamic is especially visible in markets that experienced the fastest growth during the previous cycle. Rapid appreciation created expectations that are difficult to unwind. Sellers in these areas are often the last to adjust, and as a result, they face the longest negotiation timelines. Buyers aware of this are becoming more strategic. They are not simply looking for homes, they are looking for leverage. This means targeting properties that have been on the market longer than average. It means identifying listings with multiple price cuts. It means understanding which sellers are more likely to negotiate based on their circumstances rather than their asking price. The process resembles analysis more than emotion. This analytical approach is reinforced by broader economic conditions. Uncertainty still exists, but it is no longer overwhelming. Instead, it creates a cautious optimism among buyers. They believe opportunities will emerge, and that belief encourages patience. Patience in this context is power. For sellers, this creates a new challenge. The traditional signals used to generate urgency, limited inventory, rising prices, competitive offers, are less effective when buyers are willing to wait. Even well-presented properties can struggle if priced incorrectly. Pricing, therefore, has become the most critical decision in the selling process. An accurately priced home can still attract strong interest, but the margin for error has narrowed significantly. Overpricing, even by a modest amount, can result in prolonged exposure and eventual concessions that exceed what would have been necessary with a more realistic initial price. This is not a theoretical risk, it is already happening. In many cases, the final sale price of a property reflects not just its market value, but the cost of delayed adjustment. Sellers who start too high often end up accepting lower offers than those who price correctly from the beginning. The market, in effect, is penalizing hesitation. Buyers understand this pattern, and they are incorporating it into their strategies. They are less likely to engage with newly listed properties unless the pricing is clearly competitive. Instead, they monitor listings over time, waiting for signs of adjustment. This behavior reinforces the cycle. As more buyers adopt a wait-and-see approach, sellers are forced to respond. The initial lack of offers becomes a catalyst for price changes, which then attract buyers who were previously observing from a distance. Negotiation, therefore, begins before any offer is made. It begins with time. Time reveals motivation. It reveals flexibility. It reveals how closely a seller's expectations align with reality. Buyers are learning to read these signals, and in doing so, they are redefining the negotiation process. This redefinition is not dramatic. It does not produce headlines in the way a sudden crash would. But it is significant because it alters the balance of power in a sustained way. Power in real estate has always been cyclical. There are periods when sellers dominate and periods when buyers regain control. What makes 2026 notable is the manner in which that control is shifting. It is not being taken through aggressive action, but through deliberate restraint. Buyers are not forcing the market to change, they are allowing it to correct. And in that correction, negotiation becomes central once again, not as a formality, but as the defining feature of the transaction. This is only the beginning of the shift. By the middle of 2026, the hesitation that once felt subtle had become measurable. It could be seen in the data, but more importantly, it could be felt in the rhythm of transactions. Deals were no longer closing with the speed and certainty that had defined the previous cycle. Instead, they unfolded slowly, often with pauses that revealed uncertainty on one side and patience on the other. That patience continued to belong to the buyer. In city after city, the same pattern began to emerge. Listings would appear with prices that reflected past momentum rather than current conditions. For a brief moment, there would be activity, showings scheduled, inquiries made, but without urgency behind them. Buyers would walk through homes, take notes, and leave without immediate follow-up. Days would pass, then weeks. The absence of offers was no longer unusual, it was becoming expected. Sellers, confronted with this silence, began to adjust, but not all at once. The first response was often disbelief. Many assumed that their property was simply waiting for the right buyer, someone who would recognize its value and meet the asking price without resistance. This belief, while understandable, was increasingly disconnected from reality. Because the right buyer had changed. The modern buyer in 2026 was not looking to validate the seller's expectations, they were looking to test them. This distinction reshaped every interaction. Offers, when they came, carried a different tone. They were not aggressive in the traditional sense, but they were firm. Contingencies reappeared, inspection clauses, financing conditions, appraisal protections, all elements that had been minimized or waived entirely during the peak years. Buyers were no longer willing to absorb risk simply to secure a property. Risk, like price, was now negotiable. This reintroduction of conditions created friction in transactions. Sellers who had grown accustomed to clean, unconditional offers found themselves navigating a more complex process. Each contingency represented a potential point of renegotiation, a moment where the balance of power could shift further toward the buyer. And often it did. Inspections, in particular, became a critical phase. Issues that might have been overlooked in a more competitive market were now brought forward and quantified. Repair requests were detailed. Credits were negotiated. In some cases, deals were paused or even terminated, not because the property was fundamentally flawed, but because buyers felt no pressure to compromise. There would always be another option. This belief was reinforced by inventory levels that, while not excessive, were sufficient to provide choice. Buyers no longer felt trapped by scarcity. They could compare properties, revisit listings, and take time to evaluate their decisions. Time continued to work in their favor. Sellers, on the other hand, began to experience time differently. Each additional day on the market carried weight. It signaled to buyers that something might be wrong, not necessarily with the property itself, but with its pricing or positioning. This perception, once established, was difficult to reverse. Even price reductions did not always reset the narrative. A home that had been on the market for an extended period often attracted a different kind of buyer, one who was specifically looking for leverage. These buyers approached negotiations with a clear understanding of the seller's position. They knew that time had already weakened the seller's stance, and they structured their offers accordingly. The result was a series of transactions that closed, but on terms that would have been unlikely just a few years earlier. In some cities, this shift was more pronounced than in others. Markets that had experienced rapid appreciation during the previous cycle were particularly sensitive to the change. Prices in these areas had risen quickly, often outpacing local income growth. When conditions tightened, the adjustment was not immediate, but it was inevitable. Buyers in these markets became especially cautious. They questioned not only the price of individual properties, but the sustainability of the broader trend. This skepticism translated into more conservative offers and a greater willingness to walk away from deals that did not meet their criteria. Walking away, once considered a last resort, became a common strategy. This behavior introduced a new layer of unpredictability into the market. Transactions that seemed likely to close could fall apart late in the process. Sellers, who had already adjusted their expectations once, were sometimes forced to do so again. Each failed deal reinforced the reality that the market had changed. And yet, not all sellers responded in the same way. Some adapted quickly, recognizing that the path to a successful sale required flexibility. They priced their homes competitively, responded to feedback, and engaged in negotiations with a willingness to compromise. These sellers, while not immune to the broader trends, often achieved more stable outcomes. Others resisted. For these sellers, the process became prolonged. They held onto initial expectations, interpreting each low offer as an outlier rather than a signal. Negotiations, when they occurred, were tense. Offers were countered aggressively, sometimes beyond what the market would support. Buyers, sensing this resistance, often chose not to continue the conversation. The gap remained. Over time, the consequences of this resistance became clear. Properties that lingered too long began to accumulate what could be described as market fatigue. Interest diminished. Showings declined. The listing, once new and promising, became familiar and overlooked. At that stage, even significant price reductions struggled to generate momentum. This phenomenon was not limited to any single price range. It affected entry-level homes, mid-tier properties, and higher-end listings alike. The common factor was not the type of property, but the alignment or misalignment between price and buyer expectations. Alignment had become the defining variable. Agents observing these patterns began to refine their approach. Market analyses became more detailed. Comparable sales were scrutinized with greater precision. Pricing strategies were discussed not just in terms of potential upside, but in terms of risk management. The conversation shifted from "how high can we go?" to "how long are we willing to wait?" This question, while simple, carried significant implications. For some sellers, time was not a critical factor. They could afford to wait to test the market, to see if conditions might improve. For others, time was a constraint. Relocation, financial considerations, or personal circumstances required a sale within a specific window. These differences influenced negotiation outcomes in subtle but important ways. Buyers, increasingly aware of these dynamics, sought to identify motivated sellers. Clues were found in the details: price adjustments, listing descriptions, the responsiveness of agents, even the tone of communication during initial inquiries. Each piece of information contributed to a broader assessment of how a negotiation might unfold. This level of analysis was not universal, but it was becoming more common. Technology played a role in this shift. Access to data allowed buyers to track market trends in real time. They could see how long properties had been listed, how often prices had changed, and how similar homes had performed. This transparency reduced uncertainty and, in doing so, strengthened the buyer's position. Information, once unevenly distributed, had become widely available. With that availability came a change in expectations. Buyers no longer felt compelled to accept terms that did not align with their understanding of the market. They entered negotiations with a clearer sense of value and a greater willingness to advocate for their position. This confidence, while not absolute, marked a departure from the urgency-driven behavior of previous years. Confidence replaced urgency. For sellers, this meant that traditional tactics were less effective. Creating a sense of competition required more than just listing a property. It required pricing, presentation, and timing to align in a way that genuinely attracted multiple interested buyers. When that alignment occurred, the market could still produce strong results. Well-priced homes in desirable locations continued to generate interest and, in some cases, multiple offers. But these instances were no longer the norm. They were the exception. The broader trend remained one of balance shifting toward the buyer. This shift did not eliminate negotiation, it expanded it. Every aspect of the transaction became subject to discussion: price, terms, timelines, contingencies. The process, once streamlined by competition, became more deliberate. Each decision was considered, each concession evaluated. The pace slowed, but the complexity increased. For those involved in the market, this required adjustment. Buyers needed to develop strategies that balanced patience with opportunity. Sellers needed to reassess expectations and approach negotiations with flexibility. Agents needed to guide both sides through a process that was less predictable and more nuanced. The market, in effect, was relearning how to negotiate. This relearning was not without friction. Misaligned expectations led to stalled deals. Emotional responses sometimes overshadowed rational decision-making, but over time, patterns began to stabilize. Participants adapted, strategies evolved. And gradually, a new equilibrium started to form. It was not the equilibrium of the past. It was one where buyers held more influence, not through dominance, but through discipline. They did not need to outbid each other. They needed only to remain consistent in their approach, evaluate, wait, negotiate, and, if necessary, walk away. This consistency created pressure. Pressure on prices. Pressure on timelines. Pressure on expectations. By the end of this period, it became clear that the shift was not temporary, it was structural. Negotiation had changed, and with it, the behavior of the market itself. By the latter half of 2026, the shift was no longer something that needed interpretation. It was visible in the numbers, but more tellingly, it was visible in behavior that would have seemed unlikely just a few years earlier. Buyers were not only negotiating, they were anchoring negotiations at levels below the asking price with a confidence that suggested this was no longer a risk, but an expectation. The idea of the low offer began to lose its stigma. In previous cycles, submitting an offer significantly below asking price carried a certain hesitation. Buyers worried about being dismissed, about losing the opportunity entirely. That hesitation had largely disappeared. In its place was a more calculated approach, one that treated the asking price as a starting point rather than a boundary. This change did not happen in isolation. It was reinforced by months of observable outcomes. Buyers had seen properties sit. They had watched prices fall in increments. They had observed sellers adjusting, sometimes reluctantly, sometimes repeatedly. These patterns created a new baseline for what felt reasonable. Reasonable, in this context, had shifted downward. Sellers encountering these offers faced a different kind of decision-making process. The question was no longer simply whether to accept or reject. It was whether to engage at all. Each offer, regardless of its initial level, represented a signal, an indication of how the market was perceiving the property. Ignoring that signal carried risk. For some sellers, the instinct was to reject low offers outright, to wait for something closer to their expectations. In certain cases, this strategy still worked, particularly when the property was well-positioned and competitively priced. But more often, the absence of follow-up offers forced a reconsideration. Time continued to exert pressure. As days on market extended into weeks, and in some cases, months, the definition of a low offer began to change. What once felt unacceptable started to feel like a potential path forward. Negotiations that began far apart gradually moved closer, not because buyers increased their offers significantly, but because sellers adjusted their expectations. This was the quiet normalization of downward negotiation. Price cuts accelerated during this period, but they followed a pattern that revealed more about psychology than strategy. Initial reductions were still measured, often designed to test the market rather than respond to it. But when those adjustments failed to generate sufficient interest, subsequent reductions became more decisive. Each cut was both a response and an admission. Buyers recognized this progression. They understood that multiple price reductions often indicated a seller who was becoming more flexible. This understanding influenced how they approached negotiations. Offers were timed to coincide with moments of adjustment when sellers were most receptive to compromise. Timing became a tool. In some cases, buyers would wait deliberately through one or two price reductions before engaging, allowing the market to do part of the negotiating for them. By the time an offer was submitted, the seller had already moved closer to the buyer's position, both financially and psychologically. This strategy was not universal, but it was increasingly common. The cumulative effect of these behaviors was a market in which final sale prices frequently settled below original expectations. This did not necessarily indicate distress, but it did reflect a recalibration. Sellers who entered the market with assumptions based on past conditions were, in many cases, exiting with outcomes shaped by current realities. The gap had closed, but not on their terms. At the same time, the role of fear began to shift. In earlier stages of the cycle, buyers carried the burden of uncertainty. They worried about overpaying, about entering the market at the wrong time, about committing to long-term obligations in a changing environment. By late 2026, much of that fear had been replaced by caution, and in some cases, by quiet confidence. Sellers, however, began to experience a different kind of concern. It was not always visible, and it did not always manifest immediately, but over time, it influenced decisions in subtle ways. The fear of missing the peak gave way to the fear of chasing the market downward. Sellers became more aware that waiting might not improve their position and that delays could lead to further concessions. This awareness changed behavior. Negotiations that might have stalled earlier in the year began to progress more quickly. Counteroffers became more flexible. Concessions that would have been resisted were now considered. The objective shifted from maximizing price to securing a transaction. Securing a transaction became the priority. This shift was particularly evident in properties that had experienced extended time on market. For these listings, the accumulation of time created a sense of urgency that had previously been absent. Sellers who had once been patient found themselves reassessing that patience, weighing the costs of continued waiting against the certainty of a completed sale. Certainty gained value. Buyers attuned to this change adjusted their strategies accordingly. They remained patient, but they also recognized opportunities to move decisively when conditions aligned. A property with multiple price reductions and prolonged exposure represented not just a potential deal, but a negotiation environment where their position was strongest. In these moments, the balance of power was clear. Offers were structured with precision, terms were defined carefully. Buyers sought not only price concessions, but also favorable conditions, closing cost contributions, repair credits, extended timelines where beneficial. Each element of the transaction became part of a broader negotiation framework. Nothing was assumed. This level of detail reflected a broader transformation in how transactions were approached. The process was no longer driven by competition between buyers, but by interaction between buyer and seller. The absence of bidding wars did not simplify negotiations, it made them more intricate. Each deal became its own case. For agents, this required a different set of skills. Facilitating rapid offers in a competitive environment was no longer sufficient. The role expanded to include managing expectations, interpreting market signals, and guiding clients through a process that was less predictable and more nuanced. Communication became more important. Misunderstandings could derail negotiations. Overconfidence on either side could lead to missed opportunities. Successful transactions often depended on the ability to align perceptions with reality, to bridge the gap between what one party hoped for and what the market would support. This alignment was not always easy. Emotions remained a factor, particularly for sellers. A home is not just a financial asset, it carries personal significance. Letting go of expectations tied to past valuations required a level of adjustment that was not purely analytical. It involved accepting that the market had changed and that those changes were not temporary. Acceptance took time. For buyers, the emotional landscape was different. The pressure to act quickly had diminished, and with it, some of the stress associated with the process. Decisions could be made more deliberately. Comparisons could be drawn more thoroughly. The experience, while still significant, was less reactive. Deliberation replaced urgency. This did not mean that all buyers felt confident or secure. Uncertainty remained, particularly regarding broader economic conditions, but within the context of individual transactions. The ability to negotiate provided a sense of control that had been absent in previous years. Control influenced behavior. It encouraged buyers to set clear parameters, to define what they were willing to pay and under what conditions. It also made it easier to walk away from deals that did not meet those criteria. Walking away, once a difficult decision, became a rational choice. Rational choices shaped outcomes. As more transactions reflected these dynamics, the market continued to adjust. Pricing strategies evolved. Sellers entered the market with more tempered expectations. Buyers maintained their disciplined approach. The interaction between these perspectives created a new pattern, one that was less volatile but more complex. Complexity became the defining feature. By the end of this phase, it was evident that the changes were not cyclical in the traditional sense. They were not simply a response to short-term conditions. They represented a deeper shift in how participants engaged with the market. Negotiation was no longer a final step. It was the process itself. By the closing months of 2026, the market no longer felt uncertain in the way it had at the beginning of the year. It felt defined. Not stable in the traditional sense, but understood. The patterns that had once required interpretation had become familiar. Participants, buyers, sellers, agents were no longer reacting to isolated signals. They were operating within a framework that, while still evolving, had established its core logic. That logic was built around negotiation. Not as an occasional phase, but as a constant presence in every transaction. The urgency that once drove the market had been replaced by a measured pace. Listings still moved, deals still closed, but the path from one to the other was no longer compressed. Time had stretched the process, and in doing so, it had redistributed influence. Buyers continued to hold that influence, but not in a way that suggested dominance. It was quieter than that, more inconsistent. They did not need to assert control because the structure of the market already favored their position. Sellers, by contrast, had adjusted. Not all at once, and not without resistance, but gradually over the course of the year. Expectations had been recalibrated. Pricing strategies had become more grounded. The idea of listing high and negotiating downward was no longer a strategy, it was a liability. The cost of mispricing had become too visible. Homes that entered the market with unrealistic expectations often followed a predictable trajectory. Initial interest would be limited. Days on market would accumulate. Price reductions would follow, sometimes in multiple stages. By the time the property reached a level that aligned with buyer expectations, it carried the weight of its history. That history mattered. Buyers approached these listings with a level of scrutiny that extended beyond the property itself. They considered how long it had been available, how often the price had changed, how the seller had responded to previous offers. Each detail contributed to an assessment of leverage. Leverage had become the central currency of the market. For sellers who adapted early, the experience was different. Pricing accurately from the outset did not eliminate negotiation, but it changed its nature. Instead of prolonged adjustments, these transactions often moved more efficiently. Buyers recognized value when it was presented clearly, and while they still negotiated, the process was more balanced. Balance in this environment was not about equal power, it was about alignment. When expectations on both sides reflected current conditions, deals could progress without the friction that had defined earlier stages of the shift. These transactions, while less dramatic, became the model for how the market functioned at its most effective. They demonstrated that the new equilibrium was not inherently unstable. It was simply different. In this equilibrium, outcomes were shaped less by competition and more by agreement. The absence of bidding wars did not signal weakness. It signaled a return to fundamentals: price, condition, location, and the willingness of both parties to meet within a shared understanding of value. Value itself had become more precise. During the peak years, value was often inferred from momentum. Rising prices created a feedback loop in which past performance justified future expectations. In 2026, that loop had been broken. Value was no longer assumed to increase, it had to be supported. This shift required a different kind of discipline. For buyers, it meant continuing to approach the market with patience and clarity. The advantages they held were not absolute, and they could diminish if behavior changed. A return to urgency, even in isolated cases, had the potential to alter local dynamics. But broadly, buyers maintained their position by remaining consistent, evaluating carefully, negotiating deliberately, and avoiding unnecessary risk. Consistency preserved influence. For sellers, discipline took a different form. It involved recognizing the limits of the market and working within them. This did not mean accepting unfavorable outcomes, but it did mean engaging with the process realistically. Pricing, presentation, and responsiveness became the tools through which successful sales were achieved. Adaptation defined success. Those who adapted were not necessarily those who achieved the highest prices, but those who navigated the process with the least friction. They understood that the objective was not to recreate past conditions, but to operate effectively within current ones. This distinction separated outcomes. By the end of the year, it was possible to identify clear patterns in who benefited from the shift and who struggled. Buyers who entered the market with preparation and patience often secured favorable terms. They avoided the extremes of previous cycles, both in terms of price and risk. Their decisions, while still significant, were grounded in analysis rather than urgency. Sellers who recognized the shift early and adjusted accordingly were able to complete transactions with relative efficiency. While their outcomes may not have matched peak valuations, they avoided the prolonged uncertainty and incremental concessions that characterized less adaptive approaches. Those who struggled were often those who remained anchored to past expectations. For some sellers, this resulted in extended time on market and eventual adjustments that exceeded what would have been necessary with a more realistic initial approach. For some buyers, overconfidence led to missed opportunities, waiting too long or pushing negotiations beyond what the market would support. The new equilibrium did not eliminate risk. It redistributed it. Risk was no longer concentrated in the act of making an offer quickly. It was present in the decisions that surrounded timing, pricing, and negotiation. Each participant faced different exposures, and managing those exposures became a central part of the process. This was the mature phase of the shift, not defined by rapid change, but by sustained behavior. Looking beyond 2026, the implications of this transformation extend further than a single cycle. The reintroduction of negotiation as a central feature of the market alters how future transactions will be approached, even if broader conditions evolve. Habits once formed tend to persist. Buyers who have learned to negotiate are unlikely to abandon that approach entirely, even if conditions become more competitive. Sellers who have experienced the cost of mispricing are more likely to approach future listings with caution. Agents who have navigated this environment will carry forward strategies that reflect its complexities. The market, in this sense, retains memory. That memory influences future cycles, shaping behavior in ways that are not always immediately visible. Even if demand strengthens or supply tightens, the lessons of this period remain embedded in how participants think and act. This creates a foundation for what comes next. The housing market has always been cyclical, but each cycle leaves behind structural changes. The events of 2026 are part of that process. They do not define the future entirely, but they contribute to it, setting parameters within which future dynamics will unfold. Negotiation, having re-established its role, is unlikely to recede completely. It has become integrated into the expectations of both buyers and sellers. This does not mean that every future transaction will be prolonged or complex. There will still be moments of competition, instances where demand exceeds supply, situations where urgency returns. But even in those moments, the awareness of negotiation, its possibilities, its limits, will remain present. Awareness changes behavior, and behavior shapes markets. As 2026 comes to a close, the narrative is not one of collapse or recovery, it is one of transition, a movement from one set of assumptions to another, from urgency to deliberation, from momentum to evaluation, from imbalance to a form of negotiated stability. Stability, in this context, is not static. It is maintained through continuous adjustment. Buyers adjust their expectations based on new information. Sellers respond to feedback and conditions. Agents facilitate the process, translating signals into strategy. The market evolves not in sudden shifts, but in ongoing refinement. This refinement is the defining characteristic of the current phase. It is less visible than the extremes that preceded it, but no less significant. It represents a market that is functioning with a different set of priorities, one in which outcomes are determined not by speed or pressure, but by the ability of participants to engage with each other in a structured and informed way. That engagement is negotiation. And negotiation, having changed, now defines the market itself.